you actually have a bad sell-off here and you have a broadening structure here. We don't like that. You could fall out of this framing here. You see, I've drawn a line down to there. That could take you to a very key range, the 50 range for many people, because the previous highs were at 50. You could round trip it. Remember, silver more volatile than gold. So I will always look for gold to turn first when you turn. You're in a corrective for now, falling wedge, which is long run a continuation pattern. However, continuation patterns can have complexity to them. So you could get a rally, you could come out the top side, but that doesn't mean you just go straight to new highs. You'd come out the top side, get somewhere back here, and then you fall back again. And then eventually you make a whole new winding up structure just of a much bigger scale. So you've got to bear in mind that you could first have a flush out the bottom before you break out the top. If we don't have that event, which is quite a bigger qualifier, and we break out, I would say your last week as September, this time frame here is when you should expect to break up.
Financial markets often face sudden shifts, leaving investors searching for clear technical patterns and solid macro directions amidst growing economic volatility. Understanding these movements requires analyzing historical price charts and key liquidity cycles. Francishunt, a prominent trader, technical analyst, and financial market educator, emphasizes that precious metals are moving through critical technical structures. While silver remains far more volatile than gold, current technical setups point to an explosive long-term upside call of $330 per ounce. In the short term, however, markets remain trapped inside a falling wedge corrective pattern. Investors should prepare for a potential downward flush to test previous key support levels near the $50 range before any sustained breakout occurs. If a broader demand-destroying credit event is avoided, a major bullish upside breakout is anticipated during the last week of August or early September. Meanwhile, gold's steady rise toward $4,000 highlights the long-term devaluation of fiat currency. Now, we present the clips from Francishunt's interview. Before we continue to discuss this, please hit the like button, subscribe to the channel, and ring the bell icon. Thank you, and enjoy the video.
We've actually got a call of $330 on silver to the upside, but we warn that that's not overnight. And you are in what we would describe as a continuation pattern, but the scale of everything means people get lost in their impatience. They don't want these assets to reach their full true pricing with you in them. So this includes the fixed periods of gold at $20, then the re-rating. Don't forget, Roosevelt, by sleight of hand, dishonesty, lack of integrity, forced by threat of $10,000 fine and 3-year in prison sentence, when $10,000 was a lot of money, probably run into millions in equivalent today. This was the 30s. All of America to turn over their gold. That was a confiscation. There was no option for you to own private metals. No option at all. You had to hand it in. Just as a reminder, just so that people hear some of the things I'm saying and think that's far out, man. That's not happening.
We've been here before.
It has happened.
Yeah.
It has already happened. It's not happening. There's real historical points. You just need to increase the stress. And if you don't think we're due a depression with these hypervalued stocks and this grossly over-proliferated bond market, then you need to realize and go back to point number one. If it can't continue, it stops. So go back to point number one and keep going back to point number one until you grasp it. So $20, and today you're at 4,000. That's a 200x, which represents the devaluation of the fiat, because this is gold to the dollar. A gold ounce is the same gold ounce. A silver ounce is the same silver ounce. I mean, I keep samples normally with me. There you go. That's a little silver bar. I mean, that doesn't change. Come back in 100 years. Go back to 1933. That's still the same item. It doesn't change. What's changed is the dollar. It's 1/200th of what it once was. They keep you in monkey money so that they can devalue and inflate against you. That's how they win. The biggest, singlest, most important thing to understand about the monetary system is inflation is policy. It's absolute policy. They even say that classic lie, a little bit of inflation is good. You don't want deflation. What's wrong with deflation? Deflation means your money buys you more stuff. And the debt that they added becomes a higher debt burden. They want to deflate the debt burden and deflate you and have you in fiat currency. So that's the money. So if you look at gold over here, I want to highlight a couple of things. Once we got, let's call it a free market, literally from the year of my birth, I'm born in 68. There'll be some of you watching this and chuckling. So there we go, 68, we got a price. You got a 20-year bear market from 1980 down to around low 250s. That was Brown's bottom in Britain, who of course changed the name on the clipboard, saying goodbye British people, you don't own this anymore, British state. And it's gone privately to, we never got told who he sold it. Nothing was moved. A name changed on a clipboard. Isn't that funny how someone gets to buy at the bottom? And what happened? You got your first leg of the next bull market that took you to 1927 there. Then again, you got put sideways. That was 2011. You can see it there. So this was 20 years, Darcy, right. The pullback period. That's how long they were able to suppress. Once they really got interest rates super high, and you were actually getting quite a decent yield if you bought a bond, they started the bond bull market. Bonds went up and metals went down. In 2000, the absolute low by most measures for gold, you turned. And they started the mischief of from the base of the .com, they started the mischief of the subprime lending, got you to $1927. And then you came back up. The bottom was around 2016, the Shanghai Accord. So 2011 to 2016, 5 years. So they were able to suppress you into a low for 5 years. Before it was 20 years, but that's still counted in years. Then we got to our highest point at 2000, and we went sideways in a broadening structure. We called it once, twice, 3 times, and then a lady you will break. The 4th time you broke. We called below 2000 that you will break 2000. On the 4th event, you want to be long, you will run 3000 and overperform to that. You ended up at 5,600. There were lots of other continuation patterns in that journey. But just to highlight the distance from there to there, that was around 2023, the low, and you were at the high in 2021, 2 years. So you've got a shooting star here, which does show a selling off technically, and that's why you're red here. But let's just remind you, from our once, twice, 3 times, then a lady breakout, you've had 1, 2, 3, 4, 5, 6, 7, 8, 9, 10 3-month quarterly up candles. 10 quarters up from our $1,974 call. This is going to break now to the upside. Small fractal we got in early to the upside. You're going to go through 3,000. Once we'd run 3,000, the summer of last year, we said, as the August month ends and the traders are returning to their desk, that next setup will go. Let me show you that setup. And we were leveraged long again. It had been an incredible year. Summer is a bad time. Wait for the
North American summer.
August as the traders get back to their desk. When did it happen? There, August of 25. Do you want to see it? I was in London. I was waiting it. Let's take you lower time frame. There you go. There it is. Beautiful upside HVF. We trade this low risk, highly expansive reward breakout with leverage. Your next move up, 8 weeks in a row, not one bare week. After 3,000, we had our 3,000 here, by the way. You had Trump's trade tariffs, actually. So I'm going back a bit. You had a little bit of a blow off up. You went to 3.5, and then you went into a holding pattern, all about tariffs. Where they're going to tariff gold, news, put a brakes on. Big continuation pattern, came back with leverage, smashed that. So this is where we are now.
A systemic credit crisis poses severe risks to over-leveraged institutions, threatening to trigger a massive liquidity squeeze across global financial markets. During a major market sell-off, hedge funds and commercial banks face simultaneous credit recalls, forcing the liquidation of quality assets to satisfy urgent margin calls. This reversal of quantitative easing creates a severe black hole for capital, driving a sudden spike in physical cash demand as paper debts collapse under deflationary pressure. Despite short-term downside risks, precious metals are maintaining a broader continuation pattern, while a temporary flush out of the bottom remains possible during a broader stock market correction. A breakout above resistance is projected around late August or September. Physical cash and precious metals remain vital tools to navigate this impending liquidity crunch and capture extreme asset bargains. Now, let's get back to the interview.
This is some of my draws that I've done. So you can see, for example, we had a mini head and shoulder in here. And we said, no, this is not good at 73. You're going to go lower. So we're not perma bulls that we can't see short-term price moves going down. Some people, there's never a moment Max Kaiser doesn't tell you that Bitcoin's going to $1 million or 250,000 or whatever his newest number is, even on days where it's, just about a spill. That is not a good pattern structure. We expected it to sell off. It sold off. You actually have a bad sell-off here and you have a broadening structure here. We don't like that. You could fall out of this framing here. You see, I've drawn a line down to there. That could take you to a very key range, the 50 range for many people, because the previous highs were at 50. You could round trip it. Now, many people only got in at 50 because they trade cup and handles on silver. We were in at 25.9. Remember, silver more volatile than gold. So I will always look for gold to turn first when you turn.
Okay.
So if you're asking me what would happen next, I probably wouldn't first start with the silver chart, even if the answer I want is on the silver market. I would first start on gold. And the key thing is central banks at least are buying gold. In fact, China is doing an immense amount of buying. It's a discount window. And for those that have free cash flow, I still recommend that you should be utilizing the discount window that's available now, even if it's possible. And I do retain that possibility that we could have another downward dip. Remember at that point where I say even the good stuff gets sold. That can happen in a stock market event. Why? Not because you're selling, but because hedge funds and institutions that are over leveraged in a credit crisis are getting their credit lines all asked for back at the same time and need to then close positions that they have to meet those requirements. As loans die and people write them off, it's the inverse of quantitative easing. Instead of proliferation of new debt and new money, which is expansive, you actually get a black hole that's sucking it in. That's why the dollar can spike by design. It can get a spike because everybody needs the cash to pay back the bank, and cash becomes the most valuable thing. Again, banks are your counterparty risk, so cash notes at home, physical, whilst a poor investment long-term, during times when you expect a demand-destroying event is not that far away, is incredibly useful to hold, because you'll have bargains. People will be selling their second-hand cars for next to nothing. It's all happened before in the search for cash when their leverage is being closed out. And everyone is leveraged more than they think, even people that think they have no debt. Because you suddenly lose your job. You start overusing your credit card. What happened? One employee. People, you will also have employment crisis. That's how they bring all the banks take the umbrella away when it really rains, the wind and the whole lot comes. So that's the thing. You're with a depression. You lose jobs, you lose income. There's a scarcity of money generally. Banks don't want to lend a thing, and they start calling all their loans back. So they become negative proliferators. They turn into black holes for their own liquidity and save their own skins. And they suck all their credit line back. SMEs go bust. They can't operate. No one's going on tourism. The tourist places closed down. No one's flying. The airlines closed down. The 747s are bought for pennies in the pound. All of this contagion effect. So beware. For now, we're in the falling wedge. If we don't get a demand-destroying event that breaks us down out of this pattern, and the eventual outcome is we break up through it, then I would say September. Last week of August, beginning September, it's when we broke last year. However, we're not exactly the same place we were last year. We're more indebted. We're further down the hyperscalers, the private credit, etc. route. So you've got to bear in mind that you could first have a flush out the bottom before you break out the top. If we don't have that event, which is quite a bigger qualifier, and we break out, I would say your last week as September, this time frame here is when you should expect to break up. But be cautious, because that dollar spike is still there. We have a huge call on the USD Korean won, going back to your Kospi question a while ago, of a major spike in the dollar against the Korean won. I suspect that'll also be on the yuan against the Korean won, but we have the biggest charts on the dollar. So that could be the hyperscalers breaking down, the Samsung getting re-rated downwards, SK Hynix getting clubbed, all that hyper demand now unwinding, because they started to only issue a certain amount of chips when people were ordering. They'd ask for 1 million and they'd get 500,000 because they couldn't make it. So then the orders got, okay, we'll ask for 2 million if we want 1 million. And then they only give them a quarter. So they start ever asking for higher orders, and it's a doom loop of excessive, and the price goes up. So how badly do you want to pay this and send us the money? So what you've actually get is a blow-off loop of artificial demand, that once the glut is done and it's, hey, we've got all your orders now, we've made them all, it's like, well, we don't need near as much as that anymore. Yeah. So you can create a bit of a doom loop blow-off. And I think there's an element of that. And China's due to enter the same chip making market, and they never have a problem with scale. They'll never be throttling your size of your order. They'll put 10 factories on it. So this ends. Something that can't continue ends. It's just simple.
The global semiconductor market is racing toward an unsustainable doom loop driven by artificial demand and exaggerated order books. Tech companies and hyperscalers have routinely doubled their chip orders from suppliers like Samsung and SK Hynix to secure limited allocations, creating a dangerous illusion of endless demand. As supply bottlenecks clear and China expands massive factory capacity, this artificial glut will unwind rapidly, triggering sharp downward re-ratings across tech equities and driving a sudden dollar spike against foreign currencies like the Korean won. This macroeconomic unwinding closely links to precious metals dynamics. Silver and gold continue to navigate complex technical formations amidst broader market distortion. Although a sharp liquidity shock could briefly force metals lower toward major support around the $50 level, the underlying technical structure remains a bullish continuation pattern. Once this corrective phase resolves, expected around late August or September, silver is projected to resume its macro trajectory toward an ultimate target of $330 per ounce, while gold continues reflecting paper currency devaluation. Share your thoughts about this interview in the comment section below. If you found this video helpful, please hit the like button, subscribe to the channel, and ring the bell icon. Thanks for watching.